Good evening. In this path-breaking video, we at Capital Pi are trying to understand certain nonsenses of the technical trading. Once you're trading intraday or with a swing trade of time period of 1 to 5 days, it is utterly important to really understand the nuances of how the trade is to be taken up, what the markets are saying. So in here we try to understand first, that is an anatomy of our trade setup. Then we try to understand how the supports and the resistances are built in, and the third, how we have to really take a call on a particular trade. This is a bit of a complex video, but then we will try to make it as simple as it is possible, as it is our philosophy at Capital Pi. So first of all, we see here what is a 30-minute chart of 30 days, 30 trading days of gold, that is 1 month forward. So what we see here is that this particular date, and that was 1st of November, 1st of December, this was like a Swiss referendum was taken out. This was on the last trading or on the eve of the Swiss referendum, where it was very much known that the particular referendum is going to be rejected. So gold actually had a collapse from 26,600 to the regions of 26,200 levels. Next day there was a gap up opening. As we said, the gap up opening was very much bearish, but the market turned, and so when the market turned, they had a volatile move and they recouped all the losses that they had at around Friday. We'll talk it at a later stage. Now what we saw it, that this was a volatile move on Monday, which made the prices to go to the level of 26,950, 26,975, and this particular level become a great and an important level, and so we find some support at this level of 26,975. We have resistance. People actually stopped being long on this, but then market closed at the highest point, so we can think of as an important level. After that, what happened? The prices actually on the second day had a reactionary move. Gold did nothing even at the COMEX, and so the prices just mended, and when they mended, they took support at this particular level of 26,550 and 26,600 region that you can see here. Prices mended. Even for a while they went below it, and then they went below it for a while. So these were 5 days, and then on particular day of a Tuesday, that was 9th of December, prices actually did something very meaningful. Now what was that meaningful? The first thing is that if you draw these important points of highs here, these 2 points, you get a trend line, and the trend line was something which was acting as a resistance. And what happened here was the prices actually opened gap up. The first sign of bullishness encountered a resistance at this point. There's a multiple resistance. First of all, this was a horizontal resistance at that particular level of 26,600 to 26,550. Actually the prices went above the trend line, mended it for a while, took a support around here, and then had a fly. And once again, what you saw was that the prices actually very easily crossing up this point, reaching to a high of around 26,300 or so. Then they just cooled it off. The next day prices made a high of around 26,350 or so, 27,350 or so, and particularly this whole thing became 2 price points, as 27,350 to 27,300 became kind of a resistance for the whole time. So in the next few days, 1, 2, 3, 4, 5 days, prices actually moved in a particular range of 27,350 above to 27,300 kind, and at a lower range of around lower band of around 27,050 to 26,975 or so. So this was termed as support, and this particular region was termed as resistance. Now something very interesting happened, particularly on this day of 15th of December. So this was where the call was being given, and this was a fantastic trade, fantastic setup. Prices moved up. We became cautious. Prices crossed at this juncture, had a nice doji, which was termed as a pull, throw up, throw down, or like a pull, what you can say, a cooling off bit with a lesser volumes, and then prices actually flew up. So if somebody was long, could have enjoyed, but we became very susceptible at this particular point, which is known as Doji. It is also known as Doji Star, and it is also known as Doji Evening Star. So you have a real good white candle, don't go on the color. So you have a bullish candle, you have a Doji Star in formation, you have to anticipate, and much of the money in trading is made on anticipation. So somebody who could have taken a stop loss a bit above this before even this candle was born, and as this candle ends at this particular level, and could have gone short. So this region of going short may be somewhere around 27,450 to 27,400 would have yielded you 100 points straight away in 1 hour. So 27,350 to 27,300, and keeping your stop loss intact. So this was a simple, figurative, a very simplistic evening star bearish trade, and that is what we were trying to show. So this particular resistance is, as a polarity principle says, that this was a known, you can think of a known resistance, 1, 2, 3 price points. So became a support, and which actually happened in the same way. So this is a particular trade setup known as a evening star bearish trade setup on a 30-minute chart, yielding results in a very short period of time. So these are known as CC calls, that is compressed calls, and compressed calls means it is compressed on the time frame, and now the much of the thing is being weighted up. So finally what happened, the prices next day opened gap down, and once again what you see is the beauty that this particular region obviously was a resistance, it was crossed. Now it is when the prices are once again in the range, but this particular level of 26,975 to 27,050 has been acting as a support. So there is a great finding. The finding is that this is a credible support in making. Prices once again had a flow. They actually moved up, crossed up this particular resistance level with ease, and made a new good high of 27,800. Next will be narrated in the second series. Thank you.